Hello everyone, Kshitij Maurya here from QuantInsti, and thank you for joining today's webinar on machine learning in trading with Dr. Ernest Chan. As many of you already know, Dr. Chan is the managing member of QTS Capital Management, and he has worked for leading investment banks and hedge funds since 1997. He has received his PhD in physics from Cornell University. Dr. Chan was a co-founder and principal of EXP Capital Management, which is a Chicago-based investment firm. He is also one of the best-selling authors and has published 3 books on quantitative and algorithmic trading. Here at QuantInsti, he is one of our esteemed EPAT faculty member and the author of 3 advanced self-learning courses on our interactive learning portal, Quantra. So before joining the financial industry, he was a member of IBM's Human Language Technologies group. A few numbers before we jump onto presentation. We have got hundreds of questions, believe me, from 75 plus countries, and it has become very difficult for me to cover all of them here. So what we have done is we have shortlisted some of the most common questions across if you can see these categories like getting started or how to optimize limitations. So from A to Z, we have received so many of these questions across these categories. And some of the common ones, we have picked them. And so without further ado, let's start with our first question. So welcome, Dr. Chan. How are you?
Hi, I'm well, thank you, Kashiti.
Okay, awesome. So our first question is, Dr. Chan, some of researchers have said that stock market prices are like a random walk. If it even possible, is it even possible or done by someone when it comes to a price prediction? What are the suitable input parameters for a model task to do this? So yes, Dr. Chan. Yeah.
Well, the random walk hypothesis has been formally rejected some time ago, amongst them by Dr. Andrew Lo, professor of finance at MIT. He has written a lot of very rigorous papers on this, and with many other academic researchers, it's been thoroughly debunked. However, that does not mean that it is easy to find repeatable patterns. Even though that it is not random. And the reason is that the signal to noise ratio is indeed still very small. Also, there are issues of regime shifts and also issues of what is called competition or alpha decay. So whatever arbitrage strategy that worked for a while, and if it has a very significant alpha, many researchers, many traders would have caught on, and they will start arbitraging it away. So it is indeed not easy to find a very strong signal. But that said, it is not impossible. The proof is in the pudding. You can see many quant funds such as Renaissance Technologies, Two Sigma, D Shore, PDD Partners, and on, Millennium Partners, and on, are able to generate positive returns every year and significant alpha every year. So our job is to find these hidden alphas. In terms of what parameters are suitable, well, that's certainly a very broad topic. It's each market has their own inefficiencies, and one has to differentiate between beta and alpha. There are, if the only goal that you have is to generate return, I would recommend that you can just buy and hold the spider, and that put it in the brokerage account and be happy 20, 30 years later. But the job of the trader is actually not to generate returns. it is to generate risk-adjusted return, namely that you have to make sure that every year you have positive return, because if you are just buy and hold spider, what you will get is a long drawdown period or maybe very steep drawdown. It is not unheard of for the spider to drop 22% in one day, not in a year, but in one day. So if you want to avoid that kind of situations, then trading is the alternative. So I certainly won't comment on what input parameters are suitable, because they are certainly very different for different markets and different strategies.
Well, I hope that answers the questions. The next question we have is, what are the unique benefits I get from using machine learning as a trading tool that no other tool can provide? Can I build a profitable trading strategy, not investment, using AI and ML? What is the best financial market in terms of suitability with AI and ML? What are the true capabilities and limitations of using AI and ML in trading? I believe a series of questions asked by users. So yeah, Dr. Chan.
Mm-hmm. Yes, I think that if one has a very good intuition on what the inefficiency is in a particular market, then one does not need ML or AI. This is unlike a self-driving car. In a self-driving car, you use artificial intelligence to replicate what a human can do. The human can navigate a busy street. They can avoid accidents. They can accelerate when there's no traffic. They can decelerate when there's a lot of traffic. So the AI mostly is just replicating what a human driver can do, and maybe do a better job of it, because it never get tired and you can watch 360 degree. That is not the function of ML and AI in trading, because in trading, if the human trader already can identify the inefficiency, all you need to do is to code up a quantitative strategy and automate trading. You do not need ML and AI for that. In trading, what ML and AI is deployed is to find patterns that the human trader cannot discover, and he or she cannot discover it because the relationship might be too complex between variables, or simply because there are too many variables, so many input features, or because there are no intuition about what exactly those features are going to provide us. For example, if just looking at technical indicators, there are many. You can create 50, 100 technical indicators based on one-time series, and they each has their merit. Some of them are mean reverting, some of them momentum, some of them do this, and some of them do that. Some of them works well in a volatile period, others don't. So if you have so many input parameters, input features, and you are not, you don't have a particular strong conviction of what should work and what shouldn't work, then machine learning is the only way that you can hope to extract alpha from all these features. Some of these features, on a standalone basis, may be very weak, and they can only work if it is combined in a suitable manner with other features, and which a human trader cannot really possibly do. So those are the situations when you have a lack of intuition and too many potential input, where the machine learning is most useful. Now, I should also mention that there is the notion of meta labeling in trading, which has been popularized recently by Dr. Lopez de Prado. And the idea of meta labeling is that even if you have a very clear intuition about what to trade, what the inefficiency is, you can still see if machine learning can improve the basic strategy by including other features to try to predict whether your intuition or your simple trading strategy is wrong. When is it more likely to be wrong and try to avoid those trades. So that's another way that machine learning can be used, is to apply a second layer of correction to your basic trading strategy.
Wow. So yeah, so those were some limitations and amazing capabilities AI ML can possess. Yeah. So next question is a smaller one this time. How to detect and avoid fake news or information that may affect the prediction models? Yeah,
Mm-hmm.
simple one.
Well, there are two ways. The most obvious way is that you have to use supervised learning. Somebody has to label a certain piece of news as fake. Otherwise it's the model cannot learn what is fake news. So this is very similar to a spam filter that that has been used very successfully in your Gmail or some other online mail service. You can certainly part of the Gmail spam filter is based on supervised learning, where a user designate a particular piece of mail as spam. But part of it is also unsupervised learning, where it can, based on some of the features of spam mail that the user specify, they can generalize to a clustering algorithm to, cluster those emails that are very similar in nature to the spam mail that the user has designated. So similarly with fake news, if a user can let's say hand label some of these news as fake, then the machine learning algorithm can apply it to many other news items and cluster them so that it can find this essential ingredients that make a news fake. Maybe they're they're based on features such as, for example, where they are posted, how many different venues they are posted, and the track record of the poster and so forth. Now, to talk a little bit more about the unsupervised side, so you can, for example, say that a particular financial news item is useless, is fake. It doesn't matter whether it's fake or it's just irrelevant when it produced no significant market reaction, or if the market reaction quickly mean revert in a short time period. And that one, you don't need to have a human to label it. So you can just categorize all those news which does not produce a sustained shift in price for a particular asset, for a particular stock under consideration, and then you can look for common characteristics using clustering technique on those pieces of news. So hopefully those will either be irrelevant or fake news that you can extract and detect automatically going forward.
Yeah, so basically we can tag the signals, and then based on that, AI will itself take care of it. So, interestingly, Dr. Chan, what happens? Like, it's a very curious. I was a bit curious about like what happens. Let's say if there is this news portal that got hacked, and some hacker puts a wrong news over there, but the authority of that newspaper portal or probably his Twitter handle of that portal is pretty much high. What happens? Like, is there a way, like, because that is genuine content, is there a way this AI can curb it?
It would be very hard because obviously if it is a news that is posted by a reputable organization, it lack many of the characteristics of a typical fake news, which is posted on various social media, and also very identical piece of news posted on multiple platforms. So if a top Bloomberg or Thomson Reuters pick up this news and broadcast it through the news feed, everybody would regard that as significant news. So that kind of news, I think it is extremely difficult to detect, and therefore we rely on the editor of the news surfaces to perform that function. So hopefully they will have a better algorithm to detect fake news on their end before posting it to their feed, because once they post it to their feed, I am highly doubtful that the AIM algorithm would regard it as fake news simply because of the platform that it was posted on.
Thanks for the answer. Thanks for the answer, Dr. Chan. So moving to the next question, and the next question we have is another set of questions, I would say. So yeah, how to use ML or AI for quantity management, number of shares to be bought or sold, so as to maximize profit. How to create an ML model which can work well with the uncertainty of future stock prices based on historical trends. How can a model learn to improve its operations based on trading decisions taken by it earlier? Yeah, so 3 questions. Yeah.
So the capital allocation issue has, machine learning has something to say about capital allocation. At the most basic level, a machine learning model will often provide a probability. Let's say you're talking about a classification model to see if a stock is going to go up or down. But the classification model will also provide the probability that it's going to go up or down, not just the whether it will be. So that probability can also often be used as an input to a capital allocation program. Naturally, the higher the probability that it's going to go up, you will allocate more capital to it, and if it's high probability that is less probability that it's going up, you might assign less capital to it. And if it says that it has equal probability to go up or down, then obviously you should assign no capital to it. So that can, that probability can certainly serve as an input to a capital allocation program. Now, the other way that it can impact capital allocation is if you are trying to do portfolio optimization of a lot of instruments. For concreteness, let's say stock. Now, you would know that there are many stocks that behave very similarly. Stocks such as Coca-Cola and Pepsi might go up or down together, or Google and Facebook might go up or down together, and so forth. So one goal of portfolio optimization is to utilize the covariance matrix of these stocks return, so that if you have two stocks that are very similar, we don't allocate capital to them as if they are independent. So in the limit, for example, that the two stock is simply class A and class B of the same company, you would hopefully just allocate half to each instead of assigning a full unit of capital to each, so that it would suddenly double the exposure to that particular company. So the question is the covariance approach working? And oftentimes it isn't particularly doing particularly well because of the fact that oftentimes you have to take the inverse of a matrix, and there are oftentimes a lot of singularities in taking the inverse of a covariance matrix that causes a lot of sensitivity problem. And so machine learning can help with that regard. Again, in an idea that is popularized by Dr. Lopez Prado, you can apply a hierarchical risk parity, where you use hierarchical clustering techniques to determine if two stocks, at the highest level, you want to, let's say, break up the stock universe into various big cluster. Maybe one cluster would be technology stock, another cluster would be commodity stock, and third cluster might be retail stock. But the machine learning algorithm would be able to do that on its own without you telling them that this is a retail stock or this is a technology stock and so forth. So after it clusters into some big cluster, it will continue to refine the clustering by breaking up the, let's say, the retail stock into online retailers or brick and mortar retailer or whatnot, and so on and so forth, so that at the finest level, you will find in the beverage sector, you will find Coca-Cola and Pepsi, and or even finer, you might find that you have two classes of the stock, sitting there at the leaf of this hierarchy, and you would try to you would definitely use that kind of hierarchy to allocate capital, because in the beginning, when you have the broadest classification into, let's say, a few big group, you can assign your capital, let's say, equally among the big cluster, and then as you go finer and finer in the hierarchy, you would divide your capital equally between the leaves of the hierarchical tree. So that's another way where machine learning can help with capital allocation, that this is in the form of hierarchical clustering.
Yes, so I believe that answered that questions. So covariance and everything that you can use to allocate your funds and plan your portfolio. Yes, so thanks. Next one, moving to the next question, is a basic one, and that talks about prerequisites to learn this, like how much of stats and coding is required. So yes, Dr. Chan, can you enlighten us on that?
Well, I think that the statistics required is no more than the college level, first year college level statistics, and in terms of coding, actually most of the coding required is not in machine learning per se. It is in the data science part of machine learning. In other words, nobody needs to code a machine learning algorithm anymore. There are numerous standard libraries to provide that, whether you are using Python or using MATLAB or R. Every language comes with a very well endowed library of machine learning algorithms. So no one needs to write their own unless you are a expert that want to write something so special for your data set that no one else has written before. But the problem is that to effectively use this algorithm, you have to put your data into the proper form. And you have to remove the imperfections in the data. Every data set that I've come across has problems. And based on the principle of garbage in, garbage out, if you just naively use this data as entry to your machine learning algorithm, the output will be garbage. So the most time, and some people said recently that it's 80% of the time in machine learning is actually spent on data wrangling, data science part of it, to get the input data into proper features for input. And that is especially true in financial machine learning, because there are many subtleties in financial data that a generic data scientist would not notice. And I would give you a simple example would be stationarity. Many in other consumer data, the notion of stationarity doesn't exist, because it's assumed that the data is stationary. Like spam. The characteristic of spam typically not changing over time, but that's not true for financial data. There are many financial data that are not stationary, and you cannot use that as features directly. Another example would be it's a simple example like stock splits. Many people, if they're not careful, they would just use unadjusted closing price as an input, and that would be very problematic, because you will suddenly, at the time when there's a stock split, you might think that the stock suddenly the price dropped by half, whereas actually that doesn't make sense. On the other hand, if you say, okay, well, let's just use just the data, no problem, right? So, and then you created a model, looks well, and then you live trade it. And then suddenly you will find that when you have a live data, the live data is how do you adjust for the split in the live data? Because the moment you adjust for the split in the live data, the historical data need to be revised. So just a very simple example of a stock split is going to trip up many generic data scientists who are not familiar with finance. So, you know, even in a typical machine learning project, if 80% is the time needed to fix the data, I think in financial machine learning, 90% of the time is going to be spent on fixing the data. The machine learning part is actually very short, very simple, and so to deal with the data wrangling part, a substantial amount of programming experience is needed. That's where the programming skills are needed, not in the machine learning part per se.
Yeah, so in a nutshell, what I understood, I'll just repeat. So essential parts are learning the basics of programming from the data science point of view. And you don't really necessarily understand the every bits and pieces of that because you don't need to be expert for that. There are libraries available out there which can be used, which are developed by the experts themselves. And the most important aspect is polishing the data set that you have, because majority of time, like 80%, as Dr. Chan mentioned, goes into polishing that data. So yeah, that ratio is quite huge, and thank you for explaining us like how that functions, Dr. Chan. So I believe moving to the next question that we have is also related to programming, and it says which is the better tool for trading, R or Python? Do I need to be a good programmer for learning Python? Is there really is this really for retail or intraday trader like me?
Yes. Each language has its plus and minuses, and so for example, just comparing R versus Python, the Python statistical library, the stat model, is quite frankly very poor, and in particular, many of the standard econometric time series models, you know, a Rimmer or GART or Coppola's modeling, and you know, some of the more advanced statistical models that those imply, as well as things such as you know, how to just basically determine if a time series has a co-integration, that kind of thing. They are very standard econometric model, like also common filter, and this is another example. Those things are very, very poorly constructed in stats model, which is practically the only statistical library I could find in Python. So if you are interested in classical econometric tools, Python is not for you. R is. R has most complete econometrics and statistics libraries. That's because it's been used by all these academic statisticians for years and econometricians for years. There's no question that the more traditional classical statistics, one should use R. However, the more newer libraries such as machine learning for deep learning or for random forest and so forth, you know, machine learning per se, then Python has the advantage because there are, you know, many more libraries that are written in Python in machine learning per se. So now, so when you say what tool is good for trading, it depends on what kind of quantitative models you're using. Whether you use the more traditional econometric model, whether you're using the machine learning model. And so you have to choose your language based on that. To learn Python is not so difficult, but Python is a language that has a low barrier to entry, but it is very difficult to become an expert because there are so many tricks that you need to know. I don't consider myself an expert in Python by a long shot. So yes, you don't have to be a good programmer to get started in Python, but you will need to spend a lot of time programming and learning from other people to become an expert in that language. Now, as to whether it is suitable for a retail or intraday trader, again, it depends on your trading strategy. Any language can be suitable for a retail trader because, well, I would say in this respect that Python certainly has an advantage because many of the brokers have a Python API. So you can use Python to create trading strategy and actually generate an order and submit it through the API of the broker. So in that respect, I think Python might be more suitable than other languages. So yeah, and that's certainly suitable for retail traders because it's fairly easy to use this API.
Yes, that is correct. And just to mention a fact, so according to Stack Overflow in a recent survey that they've done with the developers, Python is the fastest growing programming language in the world right now, and it is adopted on a very larger scale. And hence, there are new developers coming in and contributing with these amazing libraries, as mentioned by Dr. Chan. So yes, so that is something, an area which you would love to learn at. Thanks, Dr. Chan. So moving again to the next question that we have here is again set of questions. Uh, what would you say are the biggest obstacles for machine learning models to perform well in the market, and the biggest contributing factors to good performing models? If you could go back in time, now this is very interesting. If you go back in time and coach yourself when you just started with machine learning, what are the 5 points you could tell the younger Dr. Chen? What would your advice be to someone who is new in ML and has no university mathematics, computers, or science background? Now, these are so many questions. 5 points, Dr. Chen, from your end.
Mm-hmm. I think that the biggest obstacle for machine learning model to perform well in live trading is data snooping bias and regime change. Data snooping bias actually has a name in machine learning. It is called the bias versus variance problem. Oftentimes, you train a model very well, and it achieves very high accuracy in the training set, and it completely fall apart in the test set because it was there are too many parameters and they were overfitted to the noise of the training data rather than to features that are really repeatable. So there are many ways to overcome data snooping bias, but ultimately it is a ever-present danger because there are just a lot more parameters to fit in machine learning than in traditional quantitative trading models. The second part of the obstacle is the non-stationarity of data, and some people might call it regime shift. All machine learning model depends on the fact that the market is the same at all times. It's assuming that the statistical characteristics of the time series are constant. But that is oftentimes not true for many financial time series. Market undergoes major changes over time. For example, before and after 2008, many characteristics have changed. For example, the volatility structure of the market. In before 2008, the volatility of the U.S. index, equity index, is such that it has higher volatility but less volatility of volatility. The tail are not as thick. But after the financial crisis, because of quantitative easing and this, almost zero interest rate, most of the time volatility is very low, but the tail are significant. They are flash crash and they are sudden crash in the market and so forth. So a machine learning model that are trained on pre-financial crisis data would not work at all, would not work well in the post-crisis era. But how do you tell that there is regime shift? It's particularly challenging for machine learning because it doesn't have the context. We human know that there was a big financial crisis happen, and all the regulatory changes has happened, and the federal interest bank, the Fed's interest rate policy has changed and so forth. But the machine learning model doesn't know that because you cannot train it that way, because this thing happened once in a few decades. How can you train the model to recognize this? So this context is what a human mind can grasp, which a machine learning model cannot grasp. So this is, I think, perhaps even more problematic than data snooping. With data snooping bias, we have standard procedure to deal with it in machine learning, and it happens not just in finance, but in many other data set as well. But regime shift and non-stationarity is a unique problem in finance, and that is a problem that that it would be very hard for a machine learning model to overcome without some domain knowledge, without some guidance. And guidance that from the modeler might be to make sure that you restrict the training data to the regime that you believe it is continuing, and not to train it on just the maximum amount of data, but only restricted it to data that are within the current regime. And in fact, data snooping bias is the one thing that I wish I had been more aware of when I was starting to apply machine learning to finance, because at that time it seemed so easy. You run any number of decision tree and it come up with rules, and it works great in the back test, right? And you get so excited, but none of these actually work in live trading. That's why I had, for a long period of time, suspended my machine learning effort and focus on creating simple trading models that does not use so many features. And that's the result. That I think is the main thing that I would have to redo. Is to overcome the data snooping bias. And so for someone who does not have a background in mathematics, computer science, and you want to go into machine learning, it's not impossible. You don't have to really learn a lot of mathematics to do that, and you don't really have to know anything about theoretical computer science to do that, but you do need to, as I mentioned before, get comfortable with coding. And it's a very practical technique, so it doesn't require any formal education. It's many people are able to learn coding with none of these academic backgrounds. It is just it is a very practical endeavor, and there's nothing beats actually trying it and keep practicing it. So I don't think that you would need a theoretical academic background to get into this using this tool.
Yes, that is correct. So, thanks a tons, Dr. Chan, for sharing years of learnings and experience that you just shared. And this probably be the some sort of shortcut for the aspiring quants hearing you right here, right now. Thanks for that. The next question, yes, so that we have is, if I am pursuing the education that is outside of this program, what knowledge would be most beneficial for me prior to embarking on implementing ML in trading? Any specific courses or topics?
Well, I mean, there are many books on machine learning, and so if you are completely new to machine learning, you should definitely read those books first. one book that comes to mind is a book by Dr. Kevin Murphy, and the name of the book is it's called Machine Learning: A Probabilistic Perspective. Kevin used to be a professor of computer science, but now he's a researcher in machine learning at Google. The other book that recently published book that I think is not good to learn, I mean good to read, and that is very easy to read, is Machine Learning Yearning. Yes, it comes out. Oh yes, that book is more geared towards deep learning, but a lot of the stuff in there are quite generally applicable to machine learning. The author's name is Andrew Ng. He was a Stanford professor, but he also co-founded Coursera. Anyway, so that's a good book to have. And then, of course, after you get some basic understanding of machine learning, you can then move on to specifically financial machine learning, and that I certainly can recommend Dr. Lopez Prado's book on the advances of financial machine learning. So that's the reading that you can do, and then the rest of it is mostly learning by doing. And then, of course, I certainly can recommend the seminar that Quantra has produced, and I think Gigi can discuss more about that.
Yes, certainly. So I would announce this later, but yeah, just for everyone's knowledge, we have recently launched the learning tracks, where there are a set of courses specifically designed in a way wherein you can start from scratch, like from the very beginning. Even if you don't know basics of programming and financial markets, you can pick things up, and eventually, you can keep on learning some basic bits of programming and finance and some asset classes, and then you can further go and start creating your automated trades. So moving on to the next question that we have here. Okay, so this is another one, lengthy, a very detailed one with a lot of context here. So where do I start? What models should I explore? Simple models, deep learning? What pre-processing is required for simple models or deep learning models? I have read that using deep learning, you can forecast based on other time series values. For example, series T1 and T2 help in forecasting required series 3T. How to extend this for normal data? For example, if Trump tweets that trade war between the US and China is over, then the market will improve in another X days. In this example, what President Trump tweets is not forecastable, but still an independent event and cause the market to fluctuate. Now, there is a lot of context here. Yes, so Dr. Chan, over to you.
Yes, I think that whether one should use the two most popular machine, well, I would say three popular machine learning category are the shallow learning and random forest and deep learning. Shallow learning would include things that are linear. Logistic regression and linear regression would fit that category. And despite the simplicity, oftentimes it works very well in trading because it has less of a problem in data snooping. You will be surprised how effective it is in many trading models. Many institutional trading models are built on linear models. But as I said, after you build a linear model, there's nothing to stop you from applying meta labeling. And if you want to use meta labeling, typically there are many features. And in that case, a deeper learning model would be useful. And random forest or a gradient boosted tree model would be a favorite. And that is also used frequently in financial machine learning. Now, for deep learning, the verdict, the jury is still out on whether out of sample performance is actually still good. Then the reason is that deep learning has many more parameters than other machine learning models, and also the resulting model is very hard to interpret. But that should not stop you from exploring it. So you just have to be very careful in making sure that there's no data snooping bias. One advantage of deep learning, however, is that you don't have to it train actually much. It can train faster than the other random forest or gradient boosted decision tree model. Because of many advances in the training algorithm for deep learning. It's actually pretty fast. So, I think, however, if you are a beginner, you should start with the shallow models rather than the deep models because it presents less of a problem in overfitting, data snooping bias. Now, in terms of forecasting based on other time series, it doesn't matter that it is a deep learning model. I mean, you can apply the most shallow learning model like a linear regression, and it can take many time series as input. It has nothing to do with the classifier. It has to do, as long as a classifier can take multiple input, you can use other time series to make prediction. So that is really not necessary to use a deep learning model for that. Now, when you mention things about these treats, indeed, that is the problem that I discussed earlier, which is a challenge for machine learning model, because we never have the financial market that is so much affected by presidential treats. So therefore, this is a new regime. And unless you are able to build a machine learning model with 1 or 2 years of with 2 years of data, otherwise it may or may not work under this kind of situation. So that is the challenge of financial machine learning.
Okay, so these were the most common questions which we received. So I would take this opportunity to announce this thing, the new learning tracks that we just talked about are self-paced learning portal Quantra. This learning track, and it covers many advanced machine learning techniques which may help you generate alpha. Please do note, prior experience in programming is required to fully understand the implementation of machine learning algorithms taught in this program. However, Python programming knowledge is optional. If you want to be able to code and implement the machine learning strategies in Python, then you should be able to work with data frames. Now, these skills are covered in this learning track. There is a course called Python for Trading, which is a part of this learning track. So feel free to explore this. And for those of you who do not have any programming background and wants to start from scratch, so as rightly mentioned by Dr. Chan, you can start reading the suggested books. We have like 450 plus articles on our blog section that you can go through and read, covering different topics from very basic one to advanced. And there are also, if you are looking for jobs and everything, you will also find some content that will help you or guide you in the right direction. And apart from that, we also have a specific learning track for algorithmic trading for everyone. Now, there are no prerequisites for this learning track. You might have never coded before or never created any trading strategy. The learning curve could be steep if you are a beginner in both these skills. However, you can practically, practice regularly with hands-on learning exercises given in this learning track, and build the required skills gradually. You would not be required to install anything to successfully complete the course. The online prerequisite, the only pre sorry, the only prerequisite is your time and dedication towards learning here. So yeah, so these two are the learning tracks which I would like to introduce you to all. You can feel free to explore them. I believe there are also some discounts there, which are recent launch.
Okay, thank you. So there is a question from Marty about the risk of overfitting a single asset time series, and which going to and how to ensure that it will perform well in the out of sample data. that is, of course, a very general, a very important and a very central problem. And many people would use cross validation to make sure that when you build a model, that it is working in the validation set instead of just on the training set. And it is also important to actually perform hyperparameter optimization as well as backtesting on the validation set. And in terms of optimizing all aspects of the model. So it is not just the training the machine learning model itself, but also in optimizing its hyperparameters and also optimizing a trading strategy that utilize the output of the machine learning model that need to be done at the validation level. Because once you have optimized the model on the validation set, you only have one chance to accept or reject that model on true out of sample data. If that optimized model is rejected on the out of sample data, you should stop working on it, because if you then go back to further optimize your model, your out of sample data is no longer out of sample. So in general, we need to make sure that the validation set will be used many times in optimizing all aspects of the model and the trading strategy. Once you've done that, you get only one chance to test it on the out of sample test, and that's the way we reject a machine learning model. So when you do machine learning in trading, it is actually a enormously time-consuming process, because you will reject so many models. Unlike in a traditional trading strategy, where you can, every time you encounter something, you can take that as a improvement. If, let's say your model have a drawdown, oh well, maybe I can impose this risk indicator or that risk indicator to avoid it. In machine learning, it is actually, it's not very kosher to do that, because if you do that, you are actually running straight into the data snooping problem. And so you will find that you spend most of your time rejecting models. So let's see, what else is there? If reinforcement learning, it's actually possible, but again, it is there's no the jury is still out again on both deep learning and particularly in reinforcement learning. The problem with reinforcement learning is that there is it continues to change in adapting to the new environment. So so a back test becomes a very sort of a poor judge of whether it actually worked, because maybe it adapted well in the backtest environment, but how do you know that it will continue to adapt to the present day environment? It's a very dynamic process. So it reacts to basically every noise in the market. So I'm not particularly expert in reinforcement learning, but I also haven't found very concrete evidence that it works. I actually have a student who wrote a thesis based on reinforcement learning to trade in the stock market, but it was not very successful. So let me see if there's any other question. Yes, there is a question about whether you can use machine learning to detect market crisis and for risk management. And definitely. The idea of a meta label is actually very suitable for risk management, because as you know, the underlying model can be any trading model. It could be even a discretionary trading model, as long as you have kept a record of the discretionary trade that one has done. And then one can apply meta label to discover under what circumstance these trades are typically successful and what circumstance they are likely to lose money. And so, you know, and as a result, it can recommend capital allocation. And certainly part of the recommendation can be that you should apply zero capital to a particular trade, and that would be a risk management system. Now, there's a good question about whether we can use machine learning to whether we can just use technical variables like price and volume instead of news and fundamentals as an input to a machine learning algorithm. And the answer is yes. Oftentimes, you will find that the primary offer are prices and volume. No offense to the fundamental analysts. That's the primary offer. And the reason, as the technical analysts keep wanting to repeat, is that, you know, no matter what fundamentals is out there, fundamental trader already absorb it, and their interpretation of this fundamental news will be reflected into the price, because the fundamental trader will be trading it first. So therefore, you know, I think that is definitely there's no necessity that you have to incorporate fundamental variables in creating a machine learning model.
Thank you, everyone, especially Dr. Chan, for today's amazing session, and for all the attendees who joined us from across 75 plus countries. So that's it from my end, and have a great day.